Yeah, a lot, just covered there. And folks, if you want some supplementary information on some of the things that Jurrien was talking to, we just did an episode recently on housing with Eric Basmatian just a couple of weeks ago, talking about housing is a leading indicator of economic activity and how kind of the housing market trickles through into the broader economy. In terms of the Fed having to choose, I would actually go back and listen to, I think it's the third episode of this podcast with Grant Williams talking about the end game for central banking, this kind of Scylla and Charybdis type situation, deciding between inflation and asset bubbles and some sort of recession. But what I want to get into here, you're starting to kind of allude to there. You're in some historical analogs, right? And again, to maybe reference, this Stan Druckenmiller talk very recently. The line that he said that stood out to me is, he's like, I've been a CIO for 45 years and have never entered a situation to which there is no historical analog or precedent, kind of referring to today, which I thought, was just a stark, that's something to hear from a guy like Stan Druckenmiller. And I think, that while history is, what's the expression? It very often doesn't repeat, but it often rhymes. Jurrien, I think you're maybe one of the best guys to listen to in terms of taking lessons from history. So one of the things that's kind of breaking down on this theme of everything is breaking, right, at the current time is this correlation between stocks and bonds. And I saw a tweet from Charlie Balelo, I think, something to the effect of, in the last, 8 instances when the S&P was down, bonds were up. And that's broken this year because you've got the S&P down something like 20%. You've got bonds down 10% as well. So can you kind of walk us through what we're looking at in this chart? Just this idea of the correlation between stocks and bonds, how inflation impacts that, and why we can be looking back at the 1960s as what we can learn from this period of the 1960s.
Yeah, so just to start this conversation, I always look for analogs, not in the expectation that it's going to be a perfect repeat of history, because that's not how the world works. But as a student of history, a student of the market, kind of the first thing to do whenever the reality on the ground is changing, which is always, but sometimes it changes a little and other times it changes a lot, is I try to find parallels to see what we can learn. So during COVID, for instance, a lot of people were drawing analogs with the Great Depression, the 29 bubble, and then the early 30s. And I quickly dismissed that as a parallel, because during the early 30s, there was a massive policy error on the part of the Fed, which was barely formed at that point, as well as the fiscal side. So they let the banks fail. The Fed was way behind the curve in terms of easing. So because we had massive deflation, real rates went to like plus 10% during that 89% decline in the Dow Jones. So the Fed was, in a way, was tightening significantly into an enormous systemic depression. And obviously during COVID, we had the exact opposite of that, right? We had a fall, we had an abrupt stop to economic growth, but you had that double-barreled fiscal monetary policy response, which was completely the opposite of what we had in the late 20s, early 30s. So I often look to history either to say, well, there are some parallels, or to say, there are no parallels. Then I started looking at the 40s, and Lynn Alden has done a lot of work on that as well. The financial repression era, that was really the last time where we saw this really hard, this potent double-barreled fiscal monetary response. And on top of that, we had financial repression in terms of the Fed capping rates. So I've been using the 40s as an analog as well, and I continue to do that. But now we're kind of in the late 40s, where we have that inflationary hangover from the war. We had a 26% bear market, and maybe we're not going to be too far from that this time. So that's been another analog where some things are different, but other things are similar. And one of the things that's similar, of course, is even though we don't have a world war, maybe the war against COVID kind of, mobilized the same kind of policy response that we had back then. Then the other analog, as you are showing here on the screen, is the second half of the 1960s. So I'm not, even though we look more like the 70s right now than the 60s, but that wasn't so clear a year ago, right, when inflation was still a lot lower than it is today. But when I look at the age of the secular bull market, and by the way, that's a whole topic I need to revisit, because I don't, if there was ever things happening that makes you question the secular conviction, it's the stuff that's happening today. But that's a conversation for another time. But I've looked at kind of the second half of the 60s as a period in history that's very analogous to today in certain ways, right? So we have budding inflation. It's not so budding anymore, but back in the 60s, it was starting to creep higher. And actually, so there's the 5-year CAGR of the CPI then and now. And on the top of the panel is the S&P nominal, and you can see kind of, we're in that point of the secular trend where the curve of the slope of the trend is starting to flatten out, but the trend is not over. And again, that's been my assumption. But you had, like in 68, you had political unrest like we saw during COVID. We had social justice unrest. We had a speculative bubble. People were, and nobody really remembers this, but people were speculating in tech and space stocks back then. Any stock with the name Tronix in it was just bid up to ridiculous levels, no matter how good or bad their business model was. Kind of sounds familiar in terms of the last year or so. And if we go to the other chart, the other thing that happened was that the correlation between stocks and bonds flipped. So again, from the 40s through the 50s, we had a period of low inflation, or during the 50s, I should say, we had a period of low inflation, low interest rates, and then the inflation genie kind of got out of the bottle around 67, 68 or so. The correlation of bonds to stocks, so these are bond returns to stock returns. So a negative correlation means bonds go up while stocks go down and vice versa. That correlation troughed in 1960, flipped positive in 1966. Our correlation for this era troughed in 2015 at a very steep minus 65%, and is now still negative, but getting a lot less negative. And if you just look at the screen for the last 6 months, you can see that there's been a lot of negative months for the S&P that have been matched by negative months for the long government bond index or the Barclays Agg. And so it's been a particularly tough time for the 60-40 model or index. And the question is, will the correlation flip positive? I mean, it already has on a shorter term time frame, but on a 5-year time frame, it has not yet, just because it includes 5 years of history. But it's a big question. So if we're in the late 60s and we're going to have a structural inflation paradigm, which I think is becoming rapidly becoming the consensus, maybe not to the extreme that the 70s were, but above the Fed's target of 2%. And by the way, that 2% is the core PCE. And so you add 0.5% to that to get to the CPI, which generally trends higher than the PCE. So basically the Fed's target is 2.5%. And so if we stay above that and bonds stop becoming a buffer against losses on the equity side, then we need to rethink the 60-40. And there are ways of doing that. You can tweak the 60 side to build a more inflation-proof 60. And to do that is you swap some of the big growth names to smaller value names. I mean, small cap value is the undisputed winner historically during inflationary periods like the 40s, like the 70s. So you can kind of change the 60 around, and of course you can change the 40 around. You have more cash, less duration, more tips, maybe some high yield, which tends to have a higher spread, of course, and a lower duration than the ag. And then you start thinking about gold and crypto and other forms of hard assets. But that's kind of where we are in the 60-40. And a lot of investors may be already there because the 60-40 is just the benchmark. It's a pretty narrow benchmark. But that's, I think, potentially where we're at. And so maybe it's a regime, a secular regime shift in that sense.